Hi, everyone. Thank you for joining part two in our four-part webinar series on climate finance. Please note this webinar is being recorded and the recording will be posted on Climate Links in the coming weeks. If you have a question for any of our speakers, please use the Q&A button to add your question to the queue. So once again, for those joining, hi, welcome. Thanks for joining part two in this four-part webinar series on climate finance. As a reminder, the webinar is being recorded and the recording will be posted on Climate Links in the coming weeks. And if you have a question for any of our speakers today, you can use the Q&A button to add your question to the queue. With that, I'm going to turn it over to our moderator, Gabriel Perez, to kick us off.
Thank you, Lindsay. Thank you very much. Good morning, everyone. Happy to be here. Good morning, good afternoon, depends where you are. So welcome to today's panel discussion titled Insurance as a Tool for Mitigating Climate Risk. This session is organized by USAID Climate Finance Working Group, and we are here to explore the critical role insurance plays in managing climate risk, particularly for vulnerable communities. As the coordinator for the V20 Sustainable Insurance Facility from United Nations Environment Program Finance Initiative for Latin America and the Caribbean, I am thrilled to be part of this conversation. At the V20 CIF, our focus is on helping vulnerable groups, such as MSMEs, access financial instruments like parametric insurance. These instruments are crucial for transferring the climate risk to the financial sector, allowing communities to recover faster and build resilience to future climate events. We know that insurance, particularly parametric insurance, is not a standalone solution. It is part of a broader disaster risk management strategy. In 2023, natural catastrophes resulted in 380 billion USD in total losses, with 118 billion insured. The parametric insurance market is projected to grow from 12 billion USD in 21 to 29 billion by 2031, underscoring its increasing importance. This is according to PwC 2023. Today, we are joined by three distinguished speakers who will share their expertise on how these tools are evolving and making a difference. So we have Catherine Stallberg, Senior Risk Advisor at USAID, Center for Resilience, will share her insights on climate insurance strategies. We also have Lorraine Zhu, Head of Strategy and Partnerships at African Risk Capacity. We'll discuss country-level insurance mechanisms and how they aid in disaster recovery. We also have Jaime de Pinies, CEO of Blue Marble. He will explore parametric insurance models and their application in the market. So saying this, our first speaker, as I mentioned, is Catherine Stallberg, a Senior Risk Advisor at USAID, Center of Resilience, with 20 years of experience in humanitarian and development sectors, both domestically and internationally. She leads the disaster risk management portfolio at USAID. Catherine has been instrumental in shaping strategies for comprehensive risk management, particularly focusing on pre-enraged disaster relief. Before this role, she advised on policy related to refugees and internally displaced persons, and has a background in agricultural risk management from her time in the US Senate. Today, she will be sharing key insights into the use of climate insurance to build resilience to vulnerable communities. So, Catherine, the floor is yours. You have 10 minutes.
Great, thank you. Right, good afternoon, good morning, everybody. I'm excited to share with you some of my insights. Next slide, please. So I have the great honor of managing the disaster risk management portfolio at USAID Center for Resilience and the Bureau for Resilience, Environment, and Food Security, USAID Washington. And let's start with the definition. So the disaster risk management approach that USAID uses is individuals, households, communities, countries, and systems are able to identify their risk exposure and plan and prepare for how to manage risks, thus lessening negative impacts and improving resilient outcomes. Next slide, please. We put together this graphic so that you can see USAID's approach to disaster risk management. And this always starts with analyzing risk. So we do a risk assessment. Which risks? Who is affected? What is their level of vulnerability? From there, we look at all the ways to avert risk or reduce risk. We're looking at environmental risks, health risks, economic risks, conflict risks. We're looking at ways to make sure that livelihoods are diversified. We're building savings and assets. From there, we're looking at building capacities to adapt to risk, increasing access to services and information, improving planning and preparedness, strengthening aspirations and confidence to adapt. And all of this is really important components before we get to insurance, before we get to some of these disaster risk management tools, transferring risk to a risk pool, for example, or contingent credit, emergency loans, or catastrophe bonds. And we're doing all of this in anticipation of a disaster or a shock. And so this is all in preparation. And we would never just do insurance alone, right? It's like part of all this preparedness package. And then, of course, after the disaster strikes, we go into early response, recovery, and we're trying to build resilient systems moving forward. So since we know that there's a multitude of shocks and disasters that we need to be prepared for. So just wanted to give you this visual to show you how USAID approaches disaster risk management. Next slide, please. Okay, so today we're going to be talking about insurance, and so disaster risk financing. Let's also use the definition here that we use at USAID: ex ante or prepared, or pre-planned or prearranged financial tools to manage risks. Examples are insurance, emergency loans, contingent credit, etc. Next slide, please. So one of the exciting ways that USAID has invested in insurance is through sovereign risk insurance. Now, those of us in the US are not necessarily so familiar with sovereign risk insurance. We have insurance for our cars or our health insurance, house insurance, but sovereign risk insurance is actually catastrophic insurance purchased by a government or a humanitarian organization on behalf of the population of a country for catastrophic risks such as cyclones, droughts, floods. And USAID has gotten heavily involved with our partners at the State Department in investing in the African regional risk pool. So that's called ARC, the Africa Risk Capacity, ARC for short. And this is a public-private partnership between ARC Limited, which is a private insurance company, which Lorraine will be speaking on after me. The African Union, they have a specialized agency called ARC Agency, the World Food Program, the START Network, African Development Bank, partner countries, donors. It's a whole system working on building climate risk insurance for the African continent. Next slide, please. So this slide just is a chance to show how sovereign risk insurance works. So it's not just about a country purchasing a drought policy. It first starts with a risk assessment. So you've got to identify the risks that you're trying to protect against. So in the case of ARC, it would be drought, floods, or cyclones at this point. And then the country gets to select indicators and thresholds, so about rainfall or vegetation or greenness. And then there's a very important process that happens between the country and the various actors about drafting the response plan. So again, before the insurance is purchased, a whole plan is developed to, how would we respond if this insurance is triggered? So then the policy is purchased. And in the event of a catastrophic drought or cyclone or flood, the payout would then be determined. And so once the payout is determined, then the final response plan or final implementation plan can be finalized. Beneficiaries can be identified. Activities can be solidified. This is where you would decide, are you going to give cash assistance, in-kind food, seeds, tools, what are your interventions going to be? And then you can start your early response. And as Lorraine will talk to in the next component, ARC Limited is contractually obligated to release the funds within 10 days. So this is really our prearranged disaster risk financing, where we know that those funds are coming and we know they're coming quickly. Next slide, please. So we know the research tells us how investing early through anticipatory action is not only the right thing to do in terms of saving lives and livelihoods, but also it saves us money long term. And humanitarian assistance gaps are only growing. So this is really important about how to best use our funds. If we can prearrange it, have it ready to go, we're going to have shorter disasters and less expensive disasters. I also want to point out that this is also about building resilient systems that are country-led, country-owned. You really have the host country governments in the driver's seat here, helping with the risk assessments, helping develop the draft response plans, helping implement. And this is a really important, long-term goal of disaster risk financing. Next slide, please. All right, so I've spoken about sovereign risk insurance. And I also want to talk about another important type of insurance that USAID has been investing in, and this is parametric insurance for individual farmers, smallholder farmers, and pastoralists. One of the great things about parametric insurance are the payout amounts are fixed and specified in advance, and once they're triggered by a weather event, then the payments can be made quickly, and you don't have all that time and administrative costs eaten up by individual claims. So Jaime of Blue Marble will be speaking to their great work on parametric insurance, individual insurance products, a little bit later in the hour. Next slide, please. All right, so in my position over the past 4 years, I've had the great honor of helping USAID join a number of partnerships in this space. Back in the June 2021, in the margins of the G7, USAID joined both Instant Resilience Global Partnership, called IGP, and REAP, the Risk Informed Early Action Partnership, bringing together private sector actors, humanitarian organizations, development organizations, partner countries, donors, academics, civil society actors to improve climate risk coverage for hundreds of millions of the most climate vulnerable. And so these partnerships are robust. There's working groups, and it's really looking for those solutions, those innovative solutions. At COP27, the Global Shield Against Climate Risks was announced, and USAID has been a strong partner, again, working with Pathfinder countries to develop risk insurance programs. Most recently, I got a chance to visit Ghana, that's developing their own country insurance program, and then became recently joined the ARC program. We're also involved in the Insurance Development Forum. Again, that brings together CEOs of insurance companies with humanitarian organizations to come up with these really innovative solutions to manage climate risk for the most vulnerable. So our current USAID Center for Resilience investments include ARC Replica, which we give about $2 million a year to WFP for drought and cyclone insurance for Madagascar and Mozambique, and drought insurance for Mali and Burkina Faso, protecting those populations against climate risk. Also, we've invested in ADRIFI, which is the African Disaster Risk Financing Program at the African Development Bank, that gives technical assistance, capacity building, and helps with premium support when African countries are buying their own insurance. We've also invested in a number of years in the Financial Resilience Program at the World Bank, which funds the World Bank Disaster Risk Financing Team to give technical assistance, capacity building, workshops, product development to African countries looking to develop their own insurance products. And this program helped develop CLIP, the Kenya Livestock Insurance Program, and now DRIVE, which is an expanded version to many other countries in the Horn of Africa, to give individual insurance and financial protection to pastoralists, helping them stay in their current livelihood. We've also invested at UC Davis in the Feed the Future Innovation Lab, Markets, Risk, and Resilience, that looks at a lot of risk management tools, but specifically looks at bundling insurance with drought-tolerant seeds as a way to increase food security outcomes, build resilience. Next slide, please. So just a few takeaways. Parametric insurance offers an affordable and quick way to reimburse farmers and livestock herders for a portion of their losses. Also for sovereign risk insurance, we're protecting lives and livelihoods immediately after a disaster. International and local partnerships offer mechanisms to leverage USAID investments with private sector and civil society engagement. And finally, USAID supports mainstreaming disaster and climate risk management into national and local development planning and identifying appropriate disaster risk financing mechanisms. So that's my brief presentation for this morning, but I'd be very happy to take questions.
Thank you, Catherine. Very, very interesting. I think we have a question in the chat, but also in the Q&A. So let's see the Q&A first. So we have a question from Rakesh. It says, example of how green insurance will support green banking and vice versa for MSMEs to get this at lower rates.
Absolutely. I gave the example of bundling, drought-tolerant seeds and insurance and how that increases food security outcomes. Well, it's also required in many country contexts for farmers to get loans from banks, because we know if you have an insurance product, you're pooling your risk and transferring that risk to this pool, and therefore your sort of economic model, whether that be for an SME or for an individual farmer, is going to be improved. Because even if you experience a terrible shock, at least part of your losses are going to be reimbursed to you, which will help you stay in business, keep planting, keep your doors open, keep your payroll going. So we know climate change is happening. We know that climate variability and climate shocks are increasing in frequency and severity. And we know that we need all the tools in our toolbox. And risk management tools are really important for businesses, for farmers, and banks understand that, right? They understand that for you to be financially solid, financially resilient to these shocks, having an insurance product is going to help you stay in business and keep repaying your loans. So it's something that more and more all banks are looking into, and it's definitely something that could be explored further. And I could even refer you to our disaster risk financing colleagues at the World Bank, because through through their services, they do webinars, they do technical support. So we could even help in an individualized case, help see what potential there is.
Thank you, Catherine. We have another one from Thomas White. How affordable are these insurance products when we know that the risk profile is only increasing adverse selection? Will it the most at risk to seek out these products? Are insurance recipients able to support premiums independently, or is other support needed?
No, that's a perfect question, because we're talking about the most climate vulnerable. Often these are subsistence farmers. They're people who are in need. And so the idea that they would suddenly come up with some extra cash to pay into a program that would be there when they needed it, hopefully, on some sort of 7-year time horizon. But where is the cash going to come from? And really, should we, morally take that from other things like keeping your children in school, et cetera? Like a lot of development programming, donors are heavily involved: USAID, KFW, FCDO, to name a few. And, right now, in terms of the sovereign risk insurance and the individualized insurance, usually donors give premium support. So it's not always 100%, but it's sort of on a needs basis so that the program can at least get going. And I'll say, when it comes to individual smallholder farmers, it's usually, again, it's not insurance alone. It's part of a package of risk management tools. So often, step 1 is village savings and loans. Step 2 is improved agricultural practices, being able to expand, what you're able to produce. And then we might bring in addition to climate information services, bring in insurance as another risk management tool. So an individual farmers, actually, their savings and assets will have increased, which makes them a better, give them more potential to pay their own premiums. But even so, in these programs, usually to begin with, there's either very little cost or no cost as the program gets going. And as a farmer were to be able to, manage their risk and expand what they were producing, then maybe eventually they'd be paying their full premium.
Perfect, Catherine. We are going to have one more because of the time from Chris Perrin. Which of the insurance schemes mentioned as being invested by USAID are self-sustaining?
So, I mean, Center for Resilience, we work in some of the toughest areas. We have 14 countries in Africa, and the 15th country is Haiti. These are countries with strong enabling environments, but high needs, highest year in and year out humanitarian caseloads. So, at the moment, none of them are self-sustaining. But there is a plan in place. There is a strategy in place that a country, for example, in the ARC program may graduate after 5 years from the ADRIFI program, for example. I gave the example of integrated climate risk management. Those individual farmers, while at the beginning are having their premiums supported, the idea is some of them will graduate and pay their own. So we have an eye towards sustainability. We're not naive about that, but we're also trying to help in some of the toughest places in the world as climate change is increasing. So, yeah.
Amazing, Catherine. Thank you for sharing this relevant information. So, said this, now we are going with Lorraine Yu, Head of Strategy and Partnerships at African Risk Capacity. Lorraine leads fundraising, capital management, and strategy collaboration at ARC, focusing on donor engagement and ensuring the organization's financial sustainability. Previously, as head of actuarial at ARC, Lorraine played a key role in pricing, product development, and risk management. She has also had leadership roles at KPMG, London, and Continental Reinsurance. Lorraine will be discussing country-level insurance mechanisms and their role in disaster recovery efforts. Lorraine, over to you. You have 10 minutes. Thank you.
Thank you. I hope you can all hear me and see me.
Yes, I see you and hear you.
Great. So I'm going to run through this in the next 10 minutes. It's a lot, so I'm going to try and make you mini advocates of ARC by the time 10 minutes is over. So we are obviously an Africa-based risk pool. We're a specialized agency of the African Union, and this helps us to be able to reach all African countries, and that is important because we're trying to reach all African countries that are vulnerable. We're trying to reach all the countries that are most vulnerable to climate change and catastrophe risk, and this is obviously the best in Africa. The ARC Limited is a regulated insurance company, and the reason is this is that we need to be able to carry risk, to write capital, to price, to underwrite it, to be able to reserve it and to keep the pool going on. So we operate like a regulated insurance company, despite the fact that we're also a specialized agency of the African Union. We serve African governments, and these typically are our member states. Like Catherine was saying, we had subsequent and a lot of support from the FCDO and the KFW, who provided the initial 100 million that was required to set up a mutual insurance company that's regulated in Bermuda. So we have the seeding members, and we have the members who purchase insurance every year in the risk pool. But all in all, we are a treaty run organization that welcomes members from all African states. Those are who we serve. And just going back on this theme, I just wanted to really touch on who our member states are. We have representation from all West African countries, East African countries, Mozambique, the Congo, South Tome and Principe, and these are really the countries that are
Lorraine, I'm
facing.
so terribly sorry to interrupt. I'm so sorry. Your presentation isn't going. Could you? I think it's
Oh no,
right?
Yeah.
No problem. But yeah.
Okay. Is it not going? Oh, no, that's crazy. Okay, let me try again.
So it was up before, but I think you had to hit that little red button at the top right, I believe.
Can you see it now?
Yes, we
see
can
it.
see the one, our risk pool structure.
Mm-hmm. Can you see our risk pool members? Class C,
The next one, no.
BD. Can you see our
Yes,
footprint?
we can. Can you, but it's
Uh-huh.
still not in presentation mode.
Exactly.
Is it not?
I think
It's
it's
in
that top.
presentation mode.
No, I think you have to hit that top right button. I could be wrong. That one, I
This
think. Does not look like
is
it's
it the one that says share? No.
no.
Down at the bottom, no.
Where?
Someone's saying hit F5.
F5? Ooh, okay, let's. You all see me. F5 chucked me out of the meeting.
Oh no. Okay, that was bad advice. Maybe put it back up. I think as long as you scroll through them, it's okay.
Can you
You
see
could try
it
to,
now?
yeah, you could try to
yeah, we
PDF
can
it
see it,
otherwise
but
and show it in full screen mode, but yeah,
I can try to
otherwise
do what?
in PDF maybe just in full screen mode, but otherwise you can do slide by slide.
Right. I can no longer see it now. Is it in full?
or we can do this. So we can
Is it full? Is it in full mode now?
no.
Okay, let me just share it, and maybe Jamie, you can go while I share it, and then we can restart it.
Okay. Jaime, are you ready?
Yeah, sure. I'm happy
Yeah.
to step
Well,
in.
yeah. So let me introduce Jaime de Peniz, the CEO of Blue Marble, a consortium of leading insurance companies dedicated to expanding insurance access to underserved communities around the world. Jaime has been part of Blue Marble's funding team and has led organization to positively impact millions of people in 15 countries. With a background in finance, international development, and law, Jaime brings a unique perspective to the intersection of insurance and social good. So today, Jaime will be discussing innovate parametric insurance models and their application in emerging markets. So Jaime, you have 10 minutes. Thank you.
Great.
Go ahead.
Thank you very much. Yeah, so let me kick it off just with an introduction of ourselves. So we're a consortium of leading insurance organizations with a mission to bring insurance to underserved communities. These insurance organizations include names like Zurich Insurance and Marsh McLennan, and they all come together with this mission. And the way we deliver on it is by designing and implementing parametric climate insurance solutions to build climate and financial resilience for these communities. We see insurance as a climate adaptation tool. As it was mentioned before, insurance is really a tool within a broader strategy. It's how we see it, it's how it makes sense. And the role we play in there is working at the micro, meso, and macro level, but I'll be speaking today more at the micro and meso level. We help custom build insurance solutions and then via the consortium enable access to risk capacity to back the programs. And we can do this for programs we develop or programs that we work with. You have on the left a few testimonials of customers in this case in Colombia of a product that we have there called Café Seguro that I'll speak about in a moment. And we put this here to show examples of what is that impact that ultimately these solutions are driving in the lives of the individuals we do this for. So Luz refers to the fact that this offers peace of mind to her. It serves as a safety net for her. Jorge and Jose speak about how this enables them to pay down debt, therefore avoid over-indebtedness. And Maria tells us how this payouts, when she's struggled with a harvest of a particular season, helps her reinvest in her farm. You could think of this as a way of bouncing back and letting her get back on her feet for the next season. And what you see on the right is a few sliders of what is it that we can cover, but also helps you understand a little bit better what is the scope of potential disasters that can be covered. And I do want to highlight, sometimes we'll get problems that we cannot solve despite our best efforts. The state of the art keeps on improving, but there's a lot that can be done. And part of my role today is to build awareness about the fact that there are solutions that can be built to these problems. They're certainly emerging in frequency and severity, but something can be done with regards to insurance. And so just for your awareness. Then with regards to how we go about then going into the marketplace and delivering on our mission is by partnering with both private and public sector partners. So you'll see on the left an example of private sector partners that we have. It's a combination of food and beverage companies, financial institutions, banks, and insurance companies. And on the right side, public sector companies, combination of international organizations, NGOs, governments, and others. And we'll start programs with these entities, whether those on the left or those on the right. And once we get those going, what we like to do is layer the other part. So we may enter or start a program with a company, but then we'll try really hard to bring in a public sector partner. Then hopefully that crowds in another private sector partner, then that crowds in another public sector partner. And we believe that that method eventually creates an enabling, an ecosystem. And that ecosystem creates a virtuous cycle from which a market can emerge, and a market that can ideally be sustainable. And you see there the markets where we are currently operating, the 15 of them across Latin, Africa, and Asia, and just some reference of media where we have shown up. And now I'm going to talk about this case study that I was referencing before of Café Seguro in Colombia. This was a program that we started in 2018. And what we did is we sat down with a company, in this case with Nespresso, and we said, how is it that we can help you protect the income of the farmers that ultimately supply you with those coffee beans that you then transform and sell? How can we help you, as a result of that, strengthen your sustainability commitments with regards to the farmers? And then how is it that we can build more resilience in your supply chain, in this case, by covering the risk of what is considered in the industry a third-party risk, because it's not their own risk, but it's nevertheless relevant, because if the producers or farmers are not insured, then ultimately the produce that they're buying is at risk. So we sat down with them and realized that there was scope here to develop something. We then went in Colombia. We visited a number of stakeholders, farmers, cooperatives, did focus group surveys, following customer-centric design principles, created a prototype, we tested it, and eventually found a final product. And what we did then is realize that we're up against biggest issue that has come up before, which is the question of, well, but how is this all paid for, right? Who's paying the premium? And we actually found an innovative mechanism to do that, which was channeling end consumer premiums, in this case, fair trade. And you may be familiar with the concept, the seals in many of the goods you buy in grocery stores have them. But effectively, in this case, it meant is that some of those funds that end consumers are using are going to actually the budgets of cooperatives of farmers, and then they can decide to spend those in certain projects. And so we convinced them to spend it on insurance, went through general assemblies, the democratic process of cooperatives, and that was agreed. And there were a number of pioneering cooperatives in Colombia that decided to do this. That was in 2018. It was a good experience. We then actually in 2019 started to go to the government and said, there's something here that's interesting. You're looking to provide subsidies for insurance. Would you be interested in bundling or putting this program within that? And so they agreed. And that enabled us then to increase the cover that we were offering to existing farmers, but also expand the program to other regions. So as a result of that, we started to take this program region after region. And now fast forward, we're pretty much in all the regions of coffee farmers in Colombia. The program has now embedded many other private partners, public sector partners. We have built a supply chain of risk, which is sustainable, and the risk is diversified. And you see the impact on the bottom left, which is over 6 million payouts, more than 260,000 beneficiaries, and over 60 million in insurance protection. And this is truly a micro and meso level project, that has taken off, and we believe it's a good case study. I'm not going to say it's perfect. There's certainly things we're learning, and we keep on improving, but it's one that we're proud of, and that we believe it's a good example of how things can be built up. And as we move forward, and this is where we have started to work with USAID, is to say, how can we, in a way, replicate this in other countries, which are also, in this case, coffee producing countries, and see how we can build these ecosystems. So with the help of USAID, as part of the CFDA program, we have started a project this year. We're doing this work in Kenya. You see there the partners that are participating. We're trying to replicate this, but we're also trying to adapt it to Kenya. There are things that we have found through the customer-centric design research that can be replicated, but others not. And I'll offer an example. It's just the land holding, for example, is smaller in general, we're finding in Kenya. And as a result of that, we tend to see cooperatives with more members than what we tend to see in Colombia. And as a result of that, even this onboarding and education changes, and the complexity of it is different. So there's a lot of nuances like that we're currently adapting, but we're hoping that over the next 2 years, we can reach the targets that are laid out there in the bottom left. And we're hoping to continue developing this model, taking it to other value chains, with other private partners, with other public partners. And if you're interested in learning more, let us know. And you have here our contact details. Thank you very much.
Thank you, Jaime. I really have experienced what you are talking about the Colombia, because I work very close to them. So I know how this initiative, Café Seguro, has like improved a lot of coffee producers. So working with the private and the public sector, all the stakeholders has been very amazing. So it's something that we need to replicate across the world. So thank you for your team, because I know that you guys are amazing doing what you are doing. So thank you. So we have some questions. So let's see. So let's see. We have a lot. We have this one from Aswini Ota. Is local weather change used for deciding on the parametric climate insurance? In that case, it is based on the village, city level, or a grid of, say, 2 kilometers by 2 kilometers?
It's a great question. I mean, I think there's two questions in there, right? One is, yes, have we observed changes in the pattern of weather? I mean, we have observed it, but we also hear it. So when we go and do this field visits, and we form focus groups, a sample of the population we want to service, it comes up so frequently that is anything from crops that are planted that we're being told the planting season has shifted. I used to plant these dates. Now I don't know. There's so much uncertainty around when to make that decision of planting. And when it comes to tree crops, which you obviously don't plant, then it's about when is the flowering stage emerging, which then leads to the fruit, and there's a lot of uncertainty around that. So absolutely, that is the case. We hear it, we observe it in the data, and it's certainly one of the key problems we're solving with the caveat that we're trying to, and obviously to the extent that technology allows. And then the second part of your question, which is around the grid size or the level of resolution, that really depends, I would say, on the particular variable and the data sets available. So I would say in that regard, what we're observing is also that the data sets that are made available are also evolving. Resolutions that we used to use before, which were 25 square kilometer, 10 square kilometer, are in some instances being reduced to a few square meters, which is fantastic. We have the challenge that some of these data sets don't have that many years. And in insurance, you do need years because that's the basis on which underwriters make a decision. But these are starting to emerge. They're starting to build more confidence in the industry. And as a result of that, we're finding that underwriters are also more leaning towards accepting high resolution products, all of which means pushing the state of the art, making better the supply of products, and reducing basis risk, which is the biggest issue of parametric insurance, which will remain no matter what, but it's getting better. So I don't know if that's the direction that question was going, but I hope that has been helpful.
Yes, thank you, Jaime. I have this one. Are those insurance policies subsidized by the company, or is there a program in place to facilitate the participation of the family farmers, for example?
Yeah, so for these policies, and it depends on the country, right? Everything is different. But I'll say generically, what we're trying to do is, and I think it was mentioned before, it's very hard to at the beginning try to bring something like insurance, which doesn't normally, it's not normally top priority at all in a household. Even when you have disposable income, imagine when you don't, right? So the idea is to offer ways with catalytic funding to put the experience in front of the customer, that they see the value in it, that they see the connection with the need they have, and then they can decide whether to purchase or not, and create the environment for that trust to be built and that culture of this new service that they're many times experiencing for the first time being present. That is achieved with time, and there therefore needs to be some factors in place or building blocks in place in order to build that. What we have observed is in programs like Colombia, the actual original funding came from fair trade, as I explained. So it wasn't even a corporate. It was actually, could argue it was a corporate channeling, but it was funds ultimately that were deducted from the end consumer. We then incorporated other sources of funding, which include farmers through the cooperative and the members through the cooperative, but it also includes public funds. And if we look at crop insurance in developed markets, they tend to be subsidized because the nature of the risk tends to be quite high. So I think, and this is what we're doing, is that the solution is not necessarily to have customers pay for all, but there needs to be a sharing of this among different stakeholders, because this is a risk that is impacting everyone, and there's particular sectors of society that are disproportionately impacted by it, and not just sectors of society, but geographies and countries.
One more from Victoria Adom. What is your criteria of choosing the countries to work with?
It's a great question. Now, I would say it's a full push demand supply factor. So many times is where demand is coming from, we will go. And so we have the luxury of having a consortium structure which enables us to provide access to a wide range of countries. But I will say that there's some learnings that we have along the way. And one of them has been, for example, that in very low income settings, as was being said before, is really challenging to introduce insurance in a sustainable way with a commercial support, because the building blocks necessary for a service like insurance, which is a relatively mature service that is not the first one you introduce even in the financial services, that are not there. As a result of that, we tend to prioritize when selecting countries that are able to absorb this, public budgets that are able to absorb this. That tends to be a criteria. I'm not going to say it's exclusive, because there are other ways to complement that, but that's a factor that I think the maturity, perhaps to be able to incorporate this type of service into the economy and do it on a sustainable basis, is one of the factors. But we obviously, because of our mission, want to extend this service to as many underserved individuals as we can. And that's why we many times work with public sector entities that fill the gaps, that enable this service to go to individuals that otherwise wouldn't have access to it, even at the expense of it being sustainable, perhaps not in the short term or even in the medium term, but in the long run, there is an idea of how to get there.
Perfect, Jaime. Thank you very much for sharing your experience. So, Lorraine, are you ready to go?
Yes, I'm ready to go.
Nice. So go ahead, please.
If they could put up the slides, please.
Great, it is working now. So can you just to make a test? Can you please move forward?
Okay.
Okay, yeah, it's working. So you have 10 minutes, Lorraine. Thank you very much.
Cool. So just like I was saying, we provide parametric insurance solutions to African-wide markets, and we just don't provide parametric solutions. We provide contingency planning. This is supposed to provide initial planning and operation planning so that responding to disaster risk management can be efficient and quick. We also do strategic partnership where we also do provide premium financing, as Jamie was saying, that a lot of smallholder farmers and a lot of the people who are taking parametric insurance, a lot of the countries that are taking parametric insurance need a lot of support in terms of being able to get subsidized premiums, and this also obviously includes capacity building so that we can upscale the member states as they take parametric insurance so that they can expand the range of the disaster risk management solutions that are in their toolhouse. So in all, Africa Risk Capacity does not just provide parametric solutions. We provide a whole suite of disaster risk management response solutions so that we can upskill African state governments. But also, we just don't provide macro solutions. As you can see, we also provide meso solutions to aggregators and agribusiness and the agribusiness supply chain, so that we can de-risk the whole value chain. And we also provide support to microinsurance. Most notably, we've provided parametric insurance and capacity building solutions to the WFP-R4 solutions, and other like stakeholders and partners. We're also supporting the mainstream. So we are a total value chain provider from the macro, meso, and micro side. Next, please. So we provide solutions for 4 perils: drought, tropical cyclone, floods, and outbreaks and epidemics. And within these 4 perils, we can provide a suite of multi-peril indices. Like recently, we did a product for Djibouti where we provided a multi-peril index for drought and floods. Next, please. Also, just to say that our solutions are award-winning. We recently won 2023. Last year, we got our Closing Protection Gap Initiative, and this was for our outbreaks and epidemics insurance product, which is one of a kind. We provide outbreaks and epidemic solutions against 4 viruses, which is Marburg, filovirus, and 2 others that I will put in the chat after this. Next, please. So just to give some examples of some of the work we've done and some of the protection and parametric solutions we provided. Last year, in partnerships with the World Bank, we provided solution for Malawi, which is a social safety net program. So safety net programs these days are insurable, and the basis for insuring them is that once there's a disaster, the need for the social safety net program widens, and most often at times the design has not factored in the increase in severity. So what happens is that we provide a payout to social safety net programs so that they're able to expand their reach with the severity of the disasters that are happening. We also provide anticipatory insurance. Typically, parametric insurance products pay out at the end of the season. But what we've seen is that we can provide faster response and faster relief if you're able to provide insurance payout immediately at the end of the payout season, at the end of the germination season. So that means that we're able to pay out within the agricultural season and not after the agricultural season, which also just provides faster relief and faster immediate response to the farmers who are undergoing the effects of drought. We also, like I said, provided a one-of-a-kind multi-peril solution to Djibouti, and this was for drought and urban flooding, and we did this in collaboration of the World Bank. So we're able to tailor-make our solutions to be multi-peril, to be innovative, and to be able to serve the needs of the vulnerable populations that we're seeking to target. Next, please. So far, what has been our impact? We've been able to pay out over 230 million of payouts. We've been able to onboard humanitarian partners, and the reason why we onboard humanitarian partners is because during a crisis, it's not just governments that are responding; it's also humanitarian partners, and we've also seen the need to provide them with payouts and the fast monies that they'll receive to respond to a disaster, so that they are able to also expand their operations and reach people who are vulnerable. So far, we've had 17 countries participating in our pool, and we're hoping to grow this number. Next, please. Just to say that the last 10 years, have made significant strides in being an outstanding partner to African governments. We are A- rated, and we're also rated #1 for ESG, which goes to show that we're continuing to bring financial sustainability into the midst of the core of the work that we do. Next, please. But where does this lead us? We still have a lot of needs in the continent. We do know that over 30% of the Africa's GDP comes from agriculture. We do know that 70% of our people are engaged in subsistence farming, and we do know that this is the majority of the people who are vulnerable. We have over 700 million people who are vulnerable. And what we want to do is we want to be able to provide insurance coverage to all African states. So next, please. So we are seeking, yeah. So I think I would have skipped this. Next, I just skip it to go to our needs. Yeah, so we are seeking to scale insurance coverage to cover over 701 million vulnerable lives. This will be able to cover all the 55 countries. We believe we'll be able to do this with 200 million premium annually, and we'll be able to cover 150 of the most vulnerable and covering the other 701 through secondary effects. Next. So why do what are the issues that's making us not reach the 701 million people? We have capital constraints because the amount of capital that we need is the amount of insurance we give is tied to the amount of capital that we have. So far, we've been able to provide over 100 million coverage each year, but you can see that with this only ends up covering 30 million people annually. For us to be able to cover 150 million people, annually we'll need to have at least another 100 million capital, and we also need to promote and continue to provide premium financing. We've had a lot of significant support from our partners, NORA, the Netherlands, the USAID, the USG, the KfW, our STC, but we need to extend this support so that we're able to even provide more insurance coverage to more people. Next, please. So yeah, we're seeking to increase our capital reach. We're also increasing to incentivize our DRM practices, and this means that we'll be able to promote DRM practices, not just providing insurance, because this also ensures that we can keep insurance costs down, but also looking into other practices for reducing the cost of the disasters. So we really believe that once we're able to embed DRM into the practice, we'll be able to lower the cost of disasters in the end, not just by early response, quick targeting, and more efficient response, but also by ensuring that every African is an active participant towards DRM in Africa. Next, please. So our guiding principles are SDG, as with everyone. I'm going to skip this slide just because of time. And I'm also going to skip this just because of time. And just to say that these are all the partners that we are working with to be able to provide insurance to all African states. We have public sector run by the African Union. We have our development partners, that network, KfW, Insurance Resilience, the World Bank, who've been able to also be not providers of capital, but also providers of smart premium subsidies. We also have technical partners who've provided us with technical know-how. We also have our aggregators who are actively aggregating our farmer supply chain, value chain systems so that we can be more efficient in how we provide insurance. And of course, our insurance partners who we end up passing on the insurance catastrophe risk to, and other financial institutions. So these are all the people who make it possible to provide insurance to the 700 million and one people that we are hoping to target, and we do hope that we'll be able to scale this ambition. Thank you very much, everyone. I would like to end here. Thanks.
Thank you, Lorraine. Thank you very much for presenting. We have a lot of questions, but because of the time, so we are going to start with this one. Lorraine, if there has been 213 millions in premiums, but payouts payouts of 230 million so far. Do the premiums needs to be higher? Who is covering the loss?
Yeah, so the premiums, I mean, as the scales of disaster has continued to worsen, we can all agree that in the last 5 years, payouts, the disasters have really worsened, and that's when payouts have really worsened. So up until 5 years ago, we had only paid up to 50 million. But in the last 5 years, we've paid out the additional 150 million. So we are working very hard with our partners to not only scale up the amount of capital that we need, but also to increase our practices to not only just increase the premium, because that's not going to be the only solution, but also look at how to reduce the cost of risk, reduce the cost of what we're covering. How can we subsidize the cost of disasters? That way we can keep the premiums down. But yes, to your point, we've increasingly had to pay out more and face challenge of now having paid out more claims than premiums received.
Perfect. We have this one. Has ARC explored the feasibility of issuing a catastrophe bond to raise capital?
Yes, we have. We've explored the idea of a catastrophe bond. In fact, for many, many months. In fact, when I joined ARC, that's the only thing we talked about, a cat bond. But it's very expensive to raise, and it needs a minimum take. So far, we're providing 150 million of coverage every year. And for us to have a successful offtake, we need about 500 million of insurance coverage that is stable, that is consistent, because bond investors are not just going to give you money because you're raising a bond. They're going to look at the underlying book. How how profitable is it? What's the chance that this catastrophe is with risk? So a bond offering at this time where the reinsurance market is hardening, when reinsurance is expensive, when reinsurance is hard to find, is going to be detrimental, because the reasons reinsurance is hard to find is because catastrophes are increasing. So raising a bond right now would be tantamount to just handing over money to investors. So we are looking into the ways in which we can we can uh, we can lower our insurance costs. What we are doing is that we, together with the other risk pools in the world, which is the CRIF, which is a risk pool in Caribbean, the CDRIF, which is a risk pool in Southeast Asia, and the PARC-RIF, which is the Pacific risk pool, we are developing what we call the resilience risk pool, and we hope to put together an ILS instrument together, because we believe once we're able to join all the catastrophe risk we have in the world, we'll be able to gain the diversification benefit, we'll be able to negotiate better with the markets, and we'll be able to pass on each other's reinsurance costs. So that's the next frontier of mechanisms we're thinking about, an ELS product that covers worldwide through a subsidization and risk diversification of other risk pools and other perils. And then once we can sort that out together, it will be easier to raise a bond with stronger partners like those ones.
Great. We have another one. So we have like a 1 minute to respond. From a government donor perspective, what would be the best way to support this climate insurance structure of ARC, providing further capital or premium subsidies? Though which preferred financial vehicles, equity, guarantee, grants, among others?
So our biggest need right now is capital, and that's just because capital is very hard to explain, very hard to understand for a lot of players. A lot of players prefer to give risk premium subsidies, but we are trying to reach out to the fact that capital is also a coverage enabler, similar to how premium financing is a coverage enabler. And we do understand there's some restrictions that mean that capital cannot be easily provided, but so it becomes our biggest needs, just because there are a lot of players who are willing but unable to give it out. The most efficient mechanism would be through equity, because it allows the company to be able to raise to be able to provide coverage and to grow its book, and to be able to provide a sustainable finance for the rest of his life, because any capital that's given through debt will have to be repaid, and that takes away money from the members and the ability to to build upon this capital. So what we're really looking for is an equity finance partner who can provide capital, and also just someone who's able to explain it to other donors, because we also find that among the donors we need to run some technical assistance on how to provide capital to sovereign risk pools. I think that's what we need to do next. But for now, capital becomes our biggest need. But that being said, we want to be able to work with everyone, because we believe for us to be able to provide 701 million people with insurance coverage, we have to work with everyone who's willing to work with us, and in any way that they're willing to work with us. So we open up ourselves to the idea of collaboration in any way.
Thank you, Lorraine. So we have a lot of questions, but we cannot respond all. But thank you very much. So again, thank you to our speakers for their valuable insights today. We have seen how parametric insurance and other innovative tools can play a key role in helping vulnerable communities and MSMEs manage climate risks and recover faster. A special thanks to USAID Climate Finance Working Group for organizing this session. I hope today's discussion inspired continued collaboration in advancing climate resilience through insurance. So thank you all for joining, and now we can close the session.
Yes, thank you again for joining this part 2 in our 4-part webinar series on climate finance. As a reminder, the recording of this webinar and all the webinars in the series will be posted on Climate Links in the coming weeks. And we do hope you'll join us for the next webinar in the series, The Role of Climate Adaptation, Financing in Agriculture, next Thursday, September 12th. Thank you all.